Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Do investors need to concern themselves with whatever the next pain trade might be? Steve Sosnick, chief strategist at Interactive Brokers, joins me to discuss. Steve, it's great to see you as always. Welcome back to Trade Talks. There's frequently a consensus that some set of circumstances will cause the market to move in a given direction. Is that a bad thing? It sounds like it could be a little fatalistic.
Well, first of all, always great to see you, Jill. Investors always need to sort of be concerned with where the market consensus is. You know, one of the best and easiest strategies is trend following. And so, of course, if everybody is thinking in a certain way, that creates a trend. And that's usually something that traders are very quick to jump on. The problem is figuring out when that trend becomes something more than that, when it becomes so baked into the market's zeitgeist, for lack of a better word, that it really starts to take over the market's thinking, and so that's when the idea of the pain trade comes in. Is everybody thinking in one direction, and therefore, since markets have a way of making sometimes the maximum number of people feel incorrect at the worst time, that's the thing that we always have to be cognizant of. And in this current market, one of the key pain trades, as far as I'm concerned, is the market's love for the Magnificent Seven stocks, as we call them.
Yeah, well, I mean, Steve, you and I spoke about this back in July, where we're seeing surveys that were so overwhelmingly bullish. And I remember asking you, I mean, there could be a contra trade there, and we really have, since August to where we are now, I mean, that sort of played out if you were to take the contra trade. So my questions to you are, what are the obvious pain trades that you're looking for now?
Sure, and that you've summed it up perfectly, because we've not closed above our July 31st high since, and so it's been a rough couple of months. The pain trades now, as I see it, number one, are being led by a very narrow group of stocks, and we know what those are. And speaking on a Nasdaq call, they're all Nasdaq stocks. They're the key elements of the Nasdaq 100, of course, as well. And so doesn't mean you need to run away from them, but you need to be cognizant of the fact that if investor sentiment turns, it can turn ugly. And the problem with the pain trade is when everybody's on one side of the boat, so to speak, if everybody's long, who are you going to sell them to? That kind of idea. And so that sort of thing. The other pain trade, quite frankly, is the bond market to a large extent too. There's some esoteric stuff which really is getting overdone in terms of traders trading futures versus cash bonds, but it's super heavily levered to the point where the regulators are starting to look at it. It's one of those trades that's very, very low risk until it isn't, which was the long-term capital problem in almost exactly 25 years ago. I'm not as up on the mechanics of the bond market, and even some of my friends who are in the bond market said, that may be a little esoteric, but it means that you can get sort of stumbles in the weirdest places. But since we're primarily concerned with equities and equity options, I would say that investors need to just focus on our investor expectations for the big cap, mega cap tech leaders appropriate or a little too enthusiastic?
Steve, if we think about the Magnificent Seven versus the bond market, of course, this is an equity option show, as you had mentioned before. It seems as if liquidity and being over levered in the bond market, if I had to pick the worst of the two pain trades, I would think, the bond market would be a little bit more scary than, the Magnificent Seven having a turnaround.
Oh, unfortunately, yes. I mean, the bond market, equities rest, sort of on interest rates with a foundation. Every equity pricing model involves some sort of amount of concern about interest rates, whether how you're discounting your cash flows or your dividends or your earnings, et cetera. Well, those discounting factors are always interest rates. And in any options calculation, you're talking about forward values, which are determined by interest rates. So they underlie everything. So if the bond market goes haywire, there's really no place to hide in equities. But I don't want to make it too alarmist, because today actually had a nice what I would call a kick save in the bond market when it really looked like that yields were going to spiral out of control. Buyers stepped in, and as we're speaking, the rises in yield, the losses in price are relatively modest in bond land, which is, I think, what allowed stocks to rally the way they did.
All right, Steve, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.